It really has been a remarkable decade for equities in so many ways.
It really has. And good morning. Happy holidays to you. I was actually hearkening back to 1992. Early on in my career, I was working at William O'Neill and Investors Daily out in Los Angeles, and this whole NASDAQ 100 issue, I remember when they put the index together, and it was remarkable. But thank you for adding some perspective to your viewers here this morning. I think what's happened in the last 10 years is really a microcosm of the last 20, Brian, of the predominant negative trends and negative sentiment that's been really going on in Wall Street, which was actually a derivative from the tech wreck. So many people had such a bad taste in their mouths about equities and equity investing following the technology sector rally and obviously big bull market in the 90s. And I think that preponderance of negativity really drove people to not be invested in the first stage of this bull market. And again, we remember, we'll remind everyone that on March 23rd of this year, we published a piece saying that that was the low and that markets would rally 50% from that low. And that essentially was the control-alt-delete for this big 20-year bull market. And I think a lot of people don't understand how big secular bull markets occur. You can have a cyclical bear within a secular bull, and that's exactly what we've had. And I think the next 10 years, Brian, is going to be much different in terms of portfolio management within the bull market, meaning the last 10 years is really driven by macro and quantitative type measures and academic type trading. I think the next 10 years is going to be much more like the 80s and 90s in terms of bottoms up stock picking, where company managements really matter. And that was never more evident, quite frankly, than during the beginning phases of this, March, April, and May, where it was really company specific and really fundamentally driven. So I think we have a long ways to go. And that's why we're at 4,200 in terms of the S&P 500 for 2021.
Wow. About an 18% gain in next year. We had Craig Johnson of Piper Sandler, a guy you probably know back from your old Minneapolis days. Brian, he's at 42.25. Is it going to be, just to your point, fundamentally driven? Is it going to be fiscal policy? Is it going to be monetary policy, or D, all of the above?
I think D, all of the above. Think of the stock market as a big potpourri of a bunch of different things happening right now. And I think that's why you basically have to have positions across the board in terms of growth and value, large cap and small cap and mid cap as well. Be very diversified and watch these waves. In fact, I think you could have another big stay-at-home trade in the beginning of the year as the virus continues to spike. You could have a broadening out of the rally in terms of financials and industrials. But we really, from a secular basis, love technology, communication services, and consumer discretionary. But I think this year is going to be a year where financials, discretionary, and industrials do especially well as investors reposition for the longer term. I think there's been this short-term momentum move into value and the growth every other day, every other week type of move. I think we need to see that move on a quarterly basis, longer term, heading into 2021 and existing into 2022. 2021 is not going to be this period of normalization that everybody thinks. It's going to be a process.
Shepard Smith here. Thanks for watching CNBC on YouTube.